Next up, we have Callum Thomas, who's going to be talking about charting macro and markets, a top-down framework to efficiently assessing the market risk and the risk and return trade-off as well. He's one of the OGs of macroeconomic Twitter, and he's posted some of the most engaging content that's being used by fund managers, family offices, hedge funds, and other private investors as well. So keep an ear around and have those notebooks ready to go, and also give him a quick follow on Twitter. So as markets and economics evolve and traders are tasked with trying to see the world with far greater clarity, Callum is going to walk us through some of the key macroeconomic themes to look out for. So we've gone through the trend, we've gone through the technical, and now we're going to hear a little bit more about the macroeconomic themes through the market. So give you a warm welcome to Callum Thomas.
Okay, well, apologies in advance for the Kiwi accent. Hopefully you can understand everything I say. The goal of this presentation is to share with you some frameworks to help make sense of the world, and then actually apply some of those frameworks to the current situation. But first, a little bit about my background. Basically used to work in investment strategy and funds management, leaned towards the research side of things, and kind of just went all in on that and started my own research company. I work basically with asset allocators, so fund managers, pension companies, super funds. And if we look at the sort of the triangle, I believe I've got a pointer there, sort of the triangle of investing, of where returns typically come from, asset allocation is usually one of the key drivers. Then we've got market timing, security selection, and other things like fees, tax, etc. And I'm focused on helping clients with asset allocation, market timing. And so, going back to the first presentation, talking about the 60-40 portfolio, that's your sort of classic asset allocation. And that's what fits down there. And then sort of going into market timing, that's when you think, okay, does 60-40 make sense, or 50-50, 30-70, or zero in either of those things? Actually, maybe we go and look at other things. And so that kind of helps frame the way that I look at the world. A lot of my clients, in contrast to traders, they're taking, a 1 to 3 year view in their time frame. Maybe they take a month to actually implement some of their decisions. So it is quite a different sort of perspective on things, but ultimately we're all kind of doing the same thing. And so I think if you can probably adapt what I'm going to show you here to your own individual way of approaching things. So, and when it comes to frameworks, I mean, what do we actually mean when we're talking about a framework? It's essentially a set of beliefs and rules that you use to understand the world. If we think about the typical clients that I'm working with, they're going to have an investment framework, like a large sort of overarching, 100-page document, looking at all the different things like governance and how they select their investments and so on and so forth. And you don't need a 100-page document, but it probably actually does make sense to write down some of your basic beliefs and principles about what you're actually trying to do and how you're trying to go about things. But for the most part, we're going to be basically focusing on the research process part of things. And really it's about thinking about how to think and when you sort of approaching uncertainty in the markets and that. Okay, so again, when it comes to the actual framework that I use, this is it. So it's one page, and again, we want to try and make things simple because it's an extremely complex and challenging endeavour that we're doing here. And we want to make things as simple as possible, but no simpler. And really what we're looking at here is, what I'll typically do is start with valuations. And so that is coming up with some sort of indicator for the relevant asset or market that you're looking at. When that market is at its top, that thing should look expensive. When the market's at the bottom, that thing should be looking cheap, that indicator. And so the purpose of that is to have some sort of objective signal, some chart indicator that tells you it's cheap or expensive, and that helps give you your sort of longer-term directional bias. Thinking back to March 2020, when we had that collapse in prices across global stock markets, just about every valuation indicator that you looked at then lit up as extremely cheap. And so that really helped, kind of set aside a lot of the uncertainty, a lot of the doom and gloom that was going on there, because, when valuations get extreme enough, then they can kind of outweigh all the other things that are going on. And we'll get onto that, an example of that soon. But the problem with valuation is that you can fall into a value trap, like it might be cheap and stay cheap, or you might be in a situation where there's no extreme signal, valuation's kind of in the middle, and that's where you need to bring in other things like the cycle factors. So when I'm talking about cycle factors, it could be for equities, it's your earnings cycle, your economic cycle, inflation cycle, supply cycles. For commodities, it's looking for some sort of repeatable, reliable indicator that displays some sort of cyclicality to it, so that when it's going up and rolling over, then it kind of gives you a clue of what to do next. The other one that's critically important, probably demonstrated very well over the last few years, is monetary factors. So what the Fed's doing, what are other central banks doing, overall monetary conditions, and then finally we've got to round that out with the technical indicators. So bring in your technical analysis at the end to finesse what you're going to actually do with the timing. Because even if you are thinking, how do we position over the next year or so, you've still got that thing to decide about, when is the exact timing. We use technicals, sentiment, so surveyed sentiment, fund flows, positioning. Basically looking for extremes, because that's where you get the most interesting information from sentiment. I think of sentiment as basically providing two types of information. So when it's going through the range, it's momentum information when it gets to an extreme, and that's when you get that contrarian information. So thinking again back to March 2020, you had sentiment was extremely panicked, valuations were extremely cheap, and then you had monetary policy going into emergency stimulus mode. And so, it's never easy, and it's always a little easier in hindsight, but when you put that information into a framework, rather than kind of paying attention to the news or the noise and getting confused or fearful, if you have a framework that you can kind of rely on, then you can, it's like those children's toys where you've got the square hole, the circle hole, and and it's basically the Fed hiking rates hole, the monetary policy hole, and so it's the same kind of approach really. So that's basically it on the high-level framework, and so probably good to actually apply it to what we're seeing in today's world. On the monetary front, we basically have, so as I mentioned, we had this sort of panic rate cuts back in 2020. A lot of people are talking about pivot at the moment in terms of the Fed potentially pivoting back to easing, but the original pivot was the pivot back in March 2020 to panic really, and then the next one, which I'm alluding to here, is this pivot to tightening. And that's pretty much set in stone, or set a course for the global economy. In the second chart there, we're looking at basically the black line's the path of the global economy. It's the PMI, and given that most central banks are tightening, that's a pretty good leading indicator for that, and so pointing to pretty sharp and deep recession if we just look at that by itself. But then there's other factors to include. So interest rates, or bond yields rather, have gone up at a really significant pace. So the rate of change of bond yields is a pretty good indicator of where economic activity is going as well. Makes economic logic because interest rates go up. That means your expenses go up. It means it's harder to make sense of investment decisions. And so pretty much all the indicators that leading indicators that I'm looking at are all pointing to recession. Then there's always that matter of timing. So when figuring out when or if that recession comes is another thing. And one thing that we can look at for that is these sort of close enough to real-time indicators, the PMIs, they're basically coincident. And so the one on the left showing consumer confidence, basically crashing. There's a few different things tied in with that. The headline shocks from geopolitics, market volatility, negative wealth effects, the inflation shock. But if we look at the black line there, business confidence is pretty much following them down the drain as well. And I think the chart on the right is quite useful to think about how things are transitioning as well. There's a lot going on there. So, the first one to focus on is the red line there, and it's showing you the path of backlogs. So, as we probably all felt and knew, that backlogs were a real issue, as probably more so due to the demand shock. But then that backlog indicator has come down a lot now. Global trade's coming down, and the inventories indicator is basically going up. And so that's kind of a transition from we couldn't get enough stuff to now we've got too much stuff, because the way the inventories go up is you buy a whole bunch of stuff thinking that you're going to sell it, but then nobody turns up and buys it, and then you're kind of stuck with it. And, telling that story or thinking about how this actually works is can be quite useful just to make sense of what is otherwise, a bunch of lines on a chart. But I think taken all together, it's a base case of recession going into 2023 for the global economy. And then the next question is, what about inflation? To me, the inflation question really comes down to recession, yes or no. Most of the inflation side of things has come simply as a result of all the stimulus that went into the system. Now that those dynamics are going full circle, again with backlogs, the reason we had so much backlogs was that there was too much demand. Now that there's no demand, backlogs are coming down. And so we're likely to see inflation drifting down through most of next year. Again, borrowing from some leading indicators, it's always good to be able to see some sort of facts and figures and data that we can actually look at and observe rather than going around making wild forecasts. The other part of it there is commodity prices. Again, onto that global PMI. Just goes to show how important the path of the economy was to commodity prices, and commodity prices are obviously quite key for the overall inflation story. And then translating all of that sort of macro stuff, which is always fun and interesting to talk about, but translating that into the actual investment side of things, again, we're using a framework here. So this is basically a checkbox table. So on the left-hand side is what you would want to see to be maximum overweight equities. And so what I talked about before with the March 2020 situation, you were ticking just about all of those boxes. At the moment, so max defence would be maximum overweight bonds or cash. This year, well, for most of this year, it was actually cash rather than bonds, because bonds didn't look any good either. But if we go for that checklist, equities valuations are still on the expensive side, even though they have come down a lot. Policy is still tight and tightening. The economy thing, so the cycle thing, basically the rule is it gets either too good that it's bad, so the overheating situation, or so bad that it's good because it can't get any worse and it's actually going to turn, and it also gets policymakers to apply stimulus. And then the other part of the cycle is basically the turning down, which is we do tick the box on that now because we're kind of past that. It's so good that it's bad. Sentiment is actually on the excess pessimism side of things, and that's actually quite normal in a bear market. The sentiment generally will be, tracking in a lower range, but the more depressed the sentiment gets, the more likely it is that you have those bear market rallies. So that's kind of how we get them, and also why they can be so extreme. And then positioning. So with regards to how most people are positioned in equities or in cash, that is actually starting to come over to the other side now. So an average investor portfolio allocations to cash have gone up above long-term average. Hasn't spiked in the way that it has at the bottom of previous bear markets, but we're sort of making progress there. Technicals, again, oversold, was kind of, again, tracking in a range similar to sentiment. But the other part of technicals would be that it's, price, so stock market's broken down through a bunch of key levels. And then the other aspect is that it's in a downtrend. And so pretty much we need those things to change to get more excited about equities relative to defensive positionings. Again, I won't belabor this point too much, but when you've got quantitative easing and rate cuts, it's good for markets. When you've got quantitative tightening and interest rate rises, it's bad for equities. It's the basic rule. And then with valuations, again, we have seen a bit of progress there, but that's where it got to in March 2020. So it's kind of obvious in hindsight, but here it's pretty non-obvious. And then the other aspect of valuation is that you're going to be using some anchor to compare price to, and for PE ratios, we're talking about earnings. If we map on that economic outlook to earnings growth, that's basically pointing to an earnings recession. That's US earnings there, doesn't really look sustainable. There's a few reasons why it kind of shot up that fast, but then, recession basically means earnings go down. So, yeah, if you think about the valuation side of things, price actually has to come down a lot more if earnings are going down, which are basically, in this case, a moving target. And then in terms of technicals, so again, looking at sort of the medium, longer term technicals, it looks fairly bad. These are breadth indicators here. They're all kind of pointing in the wrong direction, or the bearish direction, maybe the right direction if you're short. But they haven't yet reached what you call oversold levels. They haven't put any bullish divergences in that would help change the opinion. And then another key part of this bear market is the tech side of things. And so, some similarities to the dot-com bubble, but very much different, not as expensive at the peak. And also the actual share of earnings in the tech sector actually went up, but still obviously needs to have a bit of correction. And one of the common questions is, when is tech a buy? When is tech going to be a value play? Looking at that chart, not quite yet. So that's another one to go through. And then moving over to the bond side of things, so looking at treasuries here, showing up as cheap on my indicators there, so undervalued. And the composite sentiment indicator there is showing up as extremely bearish, basically consensus bearish. So when you've got a situation where valuations are extreme, sentiment's extreme, that's kind of your perfect starting point, and then it's just a matter of figuring out the timing around that. And in terms of the timing or sequencing for bonds, to me, it's really the tension between inflation risk versus growth risk. So the chart on the right is showing you an inflation-based model for bond yields. Maybe they go up a little bit more based on that one. And then the chart on the left is showing you the macro model and the leading indicators, which, if we take that chart literally, maybe the relationship has broken, but if we take it literally, then 10-year goes down to 1%, sometime next year. Maybe it doesn't go to 1%, but maybe it gets somewhere towards there. And the point of this is that we're building objective evidence that we can use to take us to where we kind of need to be. And then looking at stocks versus bonds, as you might gather so far, the valuation adjustment for stocks is, it's interesting, but not interesting enough. But if you look at bonds, it's very clear where the advantage lies there. The leading indicator is also pointing to significant outperformance of bonds versus equities going into next year. Just a risk around the edges, just talking about credit spreads there. Basically, when you have extended period of rate increases, that raises the chance of some sort of credit stress event. So definitely keeping an eye on that. Also the housing market, because we have this pretty severe rate shock for housing, and the starting point was a situation of extreme overvaluation. So kind of reinforcing the whole thing. Now, before I wrap up, I also wanted to show you, so this is what's in kind of one of my main monthly reports. This is the asset allocation tilts, so underweight equities and commodities, overweight stocks and bonds. But the main thing I wanted to show you was this little colourful grid here, and I think this is definitely something that probably anyone can use, depending, and it doesn't matter what you're looking at, but you just adapt it. For me, we're looking at valuation, cycle, monetary, sentiment, technicals, and then a total score. And all this is doing is me looking at the world, pretty much, all the different charts, starters, indicators, anecdotes, anything that's relevant to inform the view. And it's either this orangey colour, green or yellow. Green's good, orange bad, yellow in between. And it's kind of a useful framework for just summing up all the different information that you're seeing. Again, it's like a checkbox. It helps you kind of, square peg, square hole, etc. And basically boil down the world's information into something that you can actually make sense of and form decisions around. So, that's the conclusions there. Basically, we want to have some sort of formalized process or framework, whether it's a tick box, whether it's a multi-page document, whether it's just a napkin that you've written something down on. Something that helps us kind of decide in advance how we're going to act when we see a certain set of situation, rather than reacting, chasing our tail. And then, in terms of the market outlook there, recession's the base case, inflation down, stocks still in a bear market, bonds probably outperform going into next year. So that's it.